In Chapter 6, I introduced the process by which my friends and I would go about constructing soccer teams back in elementary school. While the concept of choosing the best players first and the worst players last makes sense, our skill assessment of each player was, unfortunately, flawed. Rather than construct a team consisting of both defensive and offensive players, we would simply choose the players who were most likely to score first. The issue with this strategy is that we would end up with a team of all offensive players and no defensive players. In its simplest form, effective portfolio management employs very similar strategies to those used by the most successful sports teams. In hockey, the main objective is to score goals against an opposing team while preventing goals against our own net. In baseball, we want to attain as many runs as possible while limiting the number of runs scored by the opposing team. Even in tennis, we want to hit the ball past the opposing player while protecting our own side. The common trend amongst these sports is simple. In order to be victorious, one must master both offensive and defensive facets of the game. Especially when competing against the best, it will never be sufficient to have mastered just one of the two. Put simply, defensive strategies are just as important as offensive strategies. I am sure we can all remember a dynasty hockey team that should have won it all if it were not for their poor goaltending. In portfolio management, the market index is the opposing team. In order to win, our portfolio must generate a higher annualized return than the market index over a long investment period. After 25 years of experience, I have learned that this superior return can only be generated by employing a combination of both offensive and defensive strategies. During periods where the market is in an upwards trend, the goal is to ensure our portfolio has the ability to generate returns at a higher rate than that of the market index. All actions that work towards achieving this goal are placed under the umbrella of offensive strategies. However, above average returns during bull markets, periods where the market is in an upwards trend, can be completely offset by larger than average losses during market corrections. Unfortunately, for far too long, the investment community has done a poor job of recognizing the importance of principal preservation and has instead focused on stocks that possess significant offensive potential. For example, as of the time of writing this book, the latest buzz in the investment community surrounds the rise of cryptocurrencies and marijuana stocks. While these securities have provided investors with exceptional returns thus far, the potential loss which may result from a future market correction would be detrimental. Keeping this example in mind, a portfolio that strives to outperform the market index in the long run must focus on limiting the potential loss resulting from inevitable market corrections in addition to achieving above average returns during years where the market is in an upwards trend. In other words, effective portfolio management must incorporate defensive strategies in addition to its offensive strategies. As mentioned, the investment community has neglected defensive strategies for far too long. For this reason, I have dedicated this entire chapter towards A. Explaining the significant role principal preservation has in the pursuit for long-term returns, and B. Explaining how dividend growth investing encompasses various defensive mechanisms to ensure that the above-average returns achieved during bull markets are protected during market corrections. Let's discuss the importance of playing defense. Countless times throughout this book, the notion of maintaining a long-term focus when investing in the stock market has been expressed. The premium returns achieved in the long run are the direct result of our ability to remain patient investors during periods of short-term market fluctuations. While this practice is true, effective portfolio management entails outperforming the market index. In other words, achieving higher average returns over a long investment period. While the markets have historically recovered after a correction, a portfolio that has the ability to preserve more capital is likely to outperform the market index in the long run for the following three reasons. A less significant loss during market corrections has a smaller negative effect on the long-term annual average return. B, there is less value to recover, and C, the power of compounding interest. We will now provide an explanation for these 3 points by comparing the performance of the following 2 portfolios. Portfolio A is a $1 million portfolio that achieves a 15% annual average return during years where the market is in an upwards trend. After a market correction, the portfolio drops by 30%. Portfolio B, on the other hand, is also a $1 million portfolio that achieves a 10% annual average return during periods where the market is in an upwards trend. After a market correction, the portfolio value drops by 15%. For simplicity, I have assumed that both Portfolio A and Portfolio B start the same beginning values and generate the same return during years where the market is moving in an upwards trend. A less significant loss during market corrections has a smaller negative effect on the long-term annual average return. The first reason as to why capital preservation is such a vital component is straightforward. Since the percentage drop in Portfolio B is not as significant as the percentage drop in Portfolio A, the correction will have a less negative impact on Portfolio B's long-term annual average return. For clarification, since Portfolio A generates an annual return of 15% in years 1 through 6 and in year 7, the portfolio experiences a 30% decline. Over the 7-year period, the annual average return generated by Portfolio A would be 8.57%. On the other hand, since Portfolio B generates an annual return of 15% in years 1 through 6, but in year 7, the portfolio experiences a 15% decline, the annual average return for Portfolio B would be 10.71%, more than 2% greater than that of Portfolio A. The previous example illustrates that being able to prevent a significant loss during a single year of negative returns increases our annual average return drastically. To continue our sports analogy, even if our offense is simply on par with the opposing team, it is our defense that solidifies the victory. Less value to recover is the second benefit. In year 7, Portfolio B dropped in value by $150,000, while Portfolio A dropped in value by $300,000. For this reason, Portfolio B will have less value to recover before returning to its initial value of $1 million. An unrealized capital loss that has existed for an extensive period of time acts as a barrier to pursuing more profitable investment opportunities because many investors refuse to sell securities at a loss, but rather are persistent in waiting for the share price to recover. Therefore, the more time a stock spends in recovery, the longer period of time the investor is locked into the same position and unable to explore alternative investment opportunities. Thirdly, the power of compounding interest. At this point, we will demonstrate how the third reason, the power of compound interest, is arguably the most important motive to ensure our portfolio can limit the negative effects of market corrections on our principal. If you believe a refresher on this topic would serve as a benefit, I encourage you to revisit Chapter 3 of the book. How does the power of compounding interest translate into preserving our principal during market corrections? To illustrate this concept, we will refer back to our previous comparison of Portfolio A and Portfolio B. Only this time, we will extend our investment period. Our single investment cycle containing 6 years of positive returns and 1 year of negative returns will be extended to 7 full investment cycles, bringing our investment period to 49 years. In total, the 49 years will contain 42 years of positive returns and 7 years of market corrections. At the end of 49 years, Portfolio B's value grows to a total of $113 million, more than 3 times that of Portfolio A's value of $35 million. Remember, this incredible performance exhibited by Portfolio B was not a result of higher than average returns during periods where the market was in an upwards trend. In fact, for 42 years out of the 49-year investment period, Portfolio A and Portfolio B achieved the same 15% annual return. Portfolio B's outstanding performance was simply a direct result of its ability to preserve more capital during periods of market corrections. For my analytical listeners who would benefit from a more in-depth breakdown as to how compound interest played its part in our previous example, let us refer back to year 6, the final year in which Portfolio A and Portfolio B shared the same value. At this point, just before the first market correction in year 7, Portfolio A and Portfolio B had a value of $2.3 million. After the market correction, Portfolio A's value dropped by 30% down to $1.6 million, and Portfolio B's value dropped by 15% down to $1.9 million. Even though both portfolios generated a 15% return in the year following the market correction, Portfolio B's return was greater in dollar terms because the 15% return was generated on a greater amount. In other words, Portfolio B's 15% return in year 6 was generated off of $1.9 million, while Portfolio A's 15% return was generated off $1.6 million. While the implication of this single year observation may at first seem minute, it quickly becomes evident just how significant an impact the power of compounding interest has on our long-term total return once we extend the investment period over a long period of time. As shown in this example, preserving capital during market corrections is the direct result of outstanding defense and enables us to take full advantage of the power of compounding interest. Let's take a look at dividend growth investing as the ultimate downside protector. At this point, it should be very clear as to why protecting our principal during market corrections is just as important as achieving greater than average returns during bull markets. While dividend growth investing has historically generated above average returns for investors during a bull market, arguably the most important quality that has converted me to become a disciple of the investment philosophy is its ability to minimize the negative consequences associated with market corrections. There are two main reasons why dividend growth companies generally preserve more capital during market corrections than all other equity classes. Firstly, the fluctuating dividend yield, and secondly, the positive signal revealed as a result of a growing dividend track record. The dividend yield is one of the most important metrics dividend investors take into account prior to making investment decisions. In short, the investment yield represents the annual income return, that is, cash return from dividends, that the investor will receive as a percentage of the company's share price. Before the investor makes the investment, the share price is his anticipated principal value, since it will be the price he pays if he chooses to make the investment. Since bond market investors view the coupon rate to determine the payments they will receive in the form of interest as a percentage of their initial investment, you can consider the dividend yield to be the stock equivalent to the coupon rate for bonds. The dividend yield equation is structured as follows. Dividend yield equals annual dividend divided by the share price. To demonstrate how the dividend yield acts as a recession-resistant mechanism, we will need to familiarize ourselves with this equation. The annual dividend that a company pays is announced prior to the dividend being paid and remains static until the company decides to increase, decrease, or cut their dividend in future periods. Therefore, in the short run, the dividend is fixed. For instance, if a company pays a quarterly dividend, they will usually announce the next 4 quarterly payments in advance of the first payment being paid. Therefore, investors are able to see the value of the dividends they will likely receive for the next year if they decide to invest in a dividend-paying company. Unlike dividends, share prices fluctuate on a daily basis. A fluctuating share price and static dividend means that the dividend yield is negatively correlated with the company's share price. In other words, if the share price goes up and the company does not announce a change to their dividend, the dividend yield will go down, and vice versa. For example, let us assume an investor would like to purchase a share in company A because of its attractive 4% dividend yield. The share price is currently $100 and the company pays an annual dividend of $4 per share. If the share price suddenly increases to $200 and a dividend remains fixed at $4, the dividend yield will now drop to 2%. At this point, the investor may be turned off by the lower yield since they would now need to pay $200 for an annual payment of $4 instead of $100 for an annual payment of $4. The fluctuating dividend yield is the first market correction resistant mechanism that prevents dividend paying companies from losing a significant amount of value during bear markets. This defense mechanism can be explained in 3 simple steps. Step 1, in the beginning stages of a market correction, investors lose confidence and sell their dividend paying company in an attempt to get out before their stock loses more value. In the short run, this nature of panic selling amongst uneducated investors applies a downward force on the company's share price. The second step, the sharp decrease in the share price without any change to the company's dividend causes a sharp increase in the company's dividend yield. And step 3, the higher dividend yield is immediately recognized by investors seeking a higher than average income yield. As a result, investors eager to take advantage of the higher than average yield purchase the shares of the dividend paying company, placing upward pressure on the stock price once again. To further this last step, if a market correction is caused by a recession, the company's yield can provide an even greater cushioning effect to a dividend paying company's stock price. As a response to a recession, central banks generally decrease interest rates in an attempt to stimulate the economy, a tool referred to as expansionary monetary policy. When interest rates decrease, the coupon rates on interest-bearing securities such as bonds also decrease, thus reducing the income stream investors can receive by investing in newly issued bonds. This reduction causes a major shift in investment capital from interest-bearing securities to dividend-paying companies, since bond market investors are eager to obtain the same income yield they had prior to the interest rate decrease. The net result is a significant inflow of capital into dividend-paying companies, causing upward pressure on their stock prices. Let's look at a real-world example, the 2008 financial crisis. At this point, you should have a general understanding of the following concepts. A, the significant role principal preservation plays in the pursuit of long-term investment returns, and B, dividend growth investing's ability to preserve capital during bear markets as a result of fluctuating dividend yields. To explain how the fluctuating dividend yield acts as a defensive mechanism in a real-world scenario, we will compare the share price movements of the Bank of Nova Scotia, the Royal Bank of Canada, and Alphabet during the 2008 financial crisis. To compare these share price movements, we will make use of the following 3 pieces of information on all 3 companies. The share price in October 2007, the share price in the month by which the share prices had fully recovered back to their original October 7, 2007 value, the length of time the company's share price took to recover. We will use October 2007 as the base date since it is widely regarded as the beginning of the 2008 market correction. Let's look at Bank of Nova Scotia. On October 2007, the share price was $53. In September 2009, the share price was $54. Length of time to recover was 24 months. The Royal Bank of Canada, on October 2007, the share price was $56. On August 29, the share price was $56. The length of time to recover was 22 months. Now let's look at Alphabet, also known as Google. On October 2007, the share price was $353. On September 2012, the share price was $377. The length of time for Google to recover was 59 months. As you can see from the previous example, Google's share price took more than 2 years longer to recover than that of the Bank of Nova Scotia and the Royal Bank of Canada share price. The differences in recovery time can be attributed to one of 2 fundamental differences between both banks and the technology giant. First, Google operates in the technology market sector while the banks operate within the financial market sector. Considering the facts that the entire 2008 market correction was caused by companies within the financial sector, one would expect the recovery of the banks to be a lengthier process than that of a technology company. As we know, this was certainly not the case. If the difference in recovery was not a result of both banks and Google operating within different market sectors, there must be a second variable at play. The second fundamental difference between the banks and Google is the reason why both the Bank of Nova Scotia and the Royal Bank of Canada were able to recover so quickly, the fluctuating dividend yield. Just after September 2008, the bank suffered a significant sharp share price decrease in addition to the more gradual decrease they had already experienced from October 2007 to September 2008. However, within the 3 months following the sharp decrease in share prices, the share prices had recovered fairly quickly. This recovery can be attributed to the bank's decision to refrain from cutting their dividend. The combination of a static dividend with a beat-down share price presented potential investors with a very attractive dividend yield and created an inflow of investment capital. The result was an immediate upward pressure placed on the bank stock prices, which ultimately led to a faster recovery. With regards to Google, the company did not pay a dividend during the 2008 financial crisis. As a result, their share price was susceptible to significant losses as panicked sellers sold their positions without any dividend to cushion the fall. While the fluctuating dividend yield is the primary defensive mechanism that dividend-paying companies have to their advantage during market corrections, dividend growth companies have an indirect defense mechanism which provides even more downside protection. As mentioned in previous chapters, companies that have a proven track record of continually growing their dividends are regarded as fundamentally sound companies. By no means do these firms have any obligation to pay dividends. It is simply their choice. The act of not only paying a dividend, but continually increasing that dividend provides investors with a positive signal that the company has the ability to generate earnings in excess of what is required to fund future growth projects and repay debt obligations. Therefore, a track record of continuous dividend growth is not simply a cash payment paid back to shareholders. Instead, it provides investors with the comfort that the company in which they are invested is fundamentally sound and able to weather the storm in the event of a market correction. During market corrections, funds tend to flow into assets like gold because they are considered to be safe havens. Fortunately for dividend growth companies, this trend also occurs between different companies in the stock market. Since dividends provide shareholders with not only a cash payment but also reassurance that the company's operations are not under any immediate risks, potential investors are motivated to transfer their wealth from companies with more ambiguous operating risks to dividend growth companies. The indirect defense mechanism also played a part during the 2008 financial crisis. The decision for the Royal Bank of Canada and the Bank of Nova Scotia to maintain their dividend rather than cut their dividend sent a positive signal to investors that provided reassurance that the company's operations were not at risk. On the other hand, companies such as Google, who did not pay a dividend, provided their shareholders with little reassurance. Even if Google operations were not at risk, it was much more difficult for the company to share this information with shareholders. As a result, investor sentiment remained low and the company's share price took longer to recover. While the investment industry focuses entirely on offensive strategies, the ultimate goal of this chapter was to emphasize the importance of focusing on defense and illustrate the recession-resistant qualities incorporated within the dividend growth investing approach.